Can one man move trillions? On April 2nd, 2025, Donald Trump stood in the White House Rose Garden and announced a new set of tariffs. He called it Liberation Day. Within 15 minutes, S&P 500 futures had wiped out $2 trillion in value. By the end of that week, U.S. stocks had fallen 12.4%, their sharpest drop since the COVID crash of 2020. One man, one speech, $2 trillion gone before most people had even finished reading the headline. How does a single politician move markets that trade trillions of dollars a day? That's what we're breaking down today. Why Wall Street pays attention to Donald Trump. Trump isn't the first president investors have watched closely, but he moves markets differently than most. Back in 2016, the night he won the election, Wall Street expected a crash. Instead, the Dow Jones rose over 1,000 points in the following days. Investors bet on lower taxes and lighter regulation, a rally so consistent that traders started calling it the Trump trade. In 2017, that bet paid off when Congress cut the U.S. corporate tax rate from 35% to 21%, one of the largest corporate tax cuts in American history. By his second term, which began in January 2025, something had changed. Trump wasn't just a policymaker anymore. He had become, in the words of traders, a market variable. Someone whose social media posts alone could move stock prices before any actual law was passed. How politics actually moves the stock market. Here's the part most people misunderstand. Stock markets don't react to what's happening today. They react to what investors expect to happen next. That's why a single sentence from a president can matter more than an entire earnings report. If Trump threatens tariffs, investors don't wait to see if the tariffs actually happen. They start selling immediately, pricing in the risk. If he later softens his tone, buyers rush back in, betting the worst is over. This is the difference between fiscal policy, decisions about taxes, spending, and trade, which the president controls, and monetary policy, decisions about interest rates, which the Federal Reserve controls independently of the White House. Trump has enormous power over the first. Over the second, he has none, a limit that becomes very clear later in this story. And when a leader is unpredictable, markets punish that uncertainty with volatility, even if nothing has technically changed yet. Trump's biggest market-moving policies. Nowhere was this clearer than the 2025 tariff war. On April 2nd, Liberation Day, Trump imposed a minimum 10% tariff on nearly every country on Earth, with much higher rates for specific nations, pushing America's average tariff rate to about 22.5%, the highest level since 1909. Markets crashed immediately. Within a week, as 10-year Treasury bond yields broke above 4.60%, a threshold traders now treat as Trump's real pain point, he paused most of the new tariffs for 90 days. Investment newsletter The Kobisi Letter later mapped this out as a repeating tariff playbook. Trump threatens a steep tariff. Markets sell off in panic. Then, over following weeks, a deal quietly emerges and markets recover to new highs. Their own portfolio, built around trading these swings, returned 30.7% in 2025, nearly double the S&P 500's 16.4% gain that year. But not every episode ended in a deal. Trade tensions with China escalated sharply, with U.S. tariffs on Chinese goods hitting 145% and China retaliating at 125%, before both sides pulled back. In May 2025, A U.S. trade court ruled Trump had overstepped his legal authority in imposing these tariffs. Nearly a year later, in February 2026, the Supreme Court agreed, striking down the tariffs in a 6-3 ruling and forcing the government to refund an estimated $166 billion collected from over 330,000 businesses. Trump simply pivoted to a different law to keep tariffs in place. Beyond tariffs, his second-term agenda leaned hard into deregulation, an aggressive energy expansion push, and continued corporate tax relief, each one aimed at boosting business confidence, even as trade policy whipsawed markets in the opposite direction. Winners and losers during the Trump era. Every Trump policy created its own set of market winners and losers. Banks and defense contractors welcomed deregulation and higher military spending. Oil and gas companies benefited from an energy-friendly agenda, though rising crude prices later fed inflation fears. Domestic manufacturers were supposed to gain from tariffs meant to bring jobs back to America, but instead, manufacturing employment fell every month through the rest of 2025, according to U.S. labor data, as companies absorbed higher costs on imported parts. Technology firms took a hit from tariff-driven disruption to hardware and chip supply chains, though some of that pressure eased later when semiconductor tariffs were softened. Chinese exporters were squeezed hardest, losing ground through early 2026 as Washington shifted trade preference toward partners like India. And gold, the classic safe haven asset, became one of the era's biggest winners of all, hitting an all-time high above $5,594 an ounce in January 2026, as investors fled to safety from tariff shocks, a weakening dollar, and geopolitical turmoil. Trump, the Federal Reserve, and interest rates. If there's one institution Trump wanted to control but legally couldn't, it's the Federal Reserve. Throughout 2025 and into 2026, Trump repeatedly demanded that Fed Chair Jerome Powell slash interest rates, at one point calling him angry, a stupid person, and annoyed too late in public posts. He pushed for a criminal investigation into Fed renovation costs, which a federal judge later called pretextual, and threatened to fire Powell once his term ended in May 2026. Powell, whose independence is legally protected, pushed back, warning that thoughtful no one, certainly not the chair of the Federal Reserve, is above the law. The Fed did cut rates across 3 consecutive meetings in late 2025 to support a weakening job market. But by early 2026, inflation stayed stubbornly above the Fed's 2% target, and a U.S.-Israeli military campaign against Iran, which disrupted shipping through the Strait of Hormuz, a passage carrying roughly 20% of the world's oil, sent inflation tripling month over month in March 2026. That froze any chance of further rate cuts, no matter how loudly Trump demanded them. Trump could set tariffs with a signature and a Truth Social post. He could not set interest rates, and no amount of pressure on Powell changed that. Why the entire world watches Trump. For countries like India, this isn't background noise, it's directly consequential. In August 2025, Trump imposed a 50% tariff on Indian goods, a base 25% reciprocal tariff, plus another 25% specifically to punish India for continuing to buy discounted Russian oil. The impact was immediate. India's rupee fell to a 3-week low. Its stock indexes dropped about 1% in a single session, and New Delhi estimated $48.2 billion of exports were at risk, hitting textiles, gems, and jewelry hardest. 6 months later, ties reset. On February 2, 2026, Trump and Prime Minister Modi announced a new framework agreement, cutting India's reciprocal tariff from 25% down to 18%, and dropping the additional Russia-linked tariff entirely after India agreed to scale back Russian oil purchases and commit to buying $500 billion in American energy, technology, and agricultural goods over 5 years. It was a sharp swing, from one of the harshest tariff rates in Trump's entire trade war to one of his most favorable deals within a single Trump term. The pattern repeats globally. China, Europe, and emerging markets all watched their currencies, borrowing costs, and export industries shift with every Trump announcement. Proof that in this era, geopolitics and markets move as one. The bigger lesson is that politics is a market force. The deeper truth here goes beyond any one president. Politics is not separate from markets. It's one of the most powerful forces acting on them. Elections create uncertainty, and uncertainty creates volatility. Governments that change tax policy, trade rules, or foreign relationships aren't operating in a different universe from Wall Street. They're setting the conditions investors have to price in. What made the Trump era unusual wasn't that politics moved markets. It's how fast, how often, and how personally it did, down to a single post on social media. Conclusion. Donald Trump didn't just make policy during his presidencies. He became a variable markets had to price in every single day. From a 1,000-point rally the week he first won, to a $2 trillion crash in 15 minutes on Liberation Day, to a Supreme Court reversal, to a trade deal with India that swung tariffs from 50% down to 18%. The through line is the same. Markets don't just react to policy anymore. They react to power, perception, and a single post on social media. That's the real lesson of the Trump era for Wall Street and for every economy, including India's, watching from the outside.